Is Canada's housing bubble finally popping? I'm sure this is on the top of your mind right now because you've clicked on this video and you're trying to figure out what is happening in the marketplace right now and where do we go from here. Well, I can tell you that you've come to the right video. House sales are falling, prices are falling, and investors are trying to figure out how to get out of the market right now. At the center of the soon-to-burst housing bubble is the Bank of Canada. More specifically, it's their interest rate setting policy, which is currently sitting at 2.5% and is expected to go to 3.25% come October. What we do know is that it will take the next few months for the housing market to either cool or crash, whichever comes first. And what will all that waiting mean for homeowners, for landlords, for investors, and for those that are stuck in a very tough rental market? And the same waiting period also applies to aspiring buyers or recent homeowners who purchased their home as an investment property. These are just some of the questions going around right now. They're on your mind. They're on my mind. I'm sure they're on the mind of my next door neighbor. These questions are what everyone is asking. What happens next? And that's why I made this video, to talk about where the market has been, where it's potentially headed, and what does it mean for you today. As the Bank of Canada continues to raise interest rates, that means home prices fall. This will also force many investors to reconsider their fiscal statements, and they might be forced to sell because of these rising rates. In other words, if the central bank continues to raise interest rates, rent payments on rental properties will no longer cover even the interest portion of a mortgage. That will force many investors to force sell their properties. Because let's face it, no investor wants to bleed money every single month. There was one point where investors might have considered that I will absorb this negative cash flow because I know that my capital property or my investment property will appreciate in price and that I can offload it for a 15% tax-free gain. But this is no longer the case today. Price gains that we've been seeing in the market for the last little while, they have come with an explosion of debt. This has been fueled by more and more Canadians taking on more and more debt to fuel their house purchases, which has fueled price gains in return. And that led a lot of people to think that, hey, wait a minute, this is starting to look like what happened in the US and what got the US into trouble back in 2008. So maybe the same thing will happen in Canada and get Canada into trouble as well. But on the other side of that debate is that Canada is not like the US. And that's because we have very high population growth due to our very high levels of immigration. Canada is expected to add 1.2 million new immigrants over the next 3 years. And the US, it's a lot more restrictive into welcoming in new immigrants. And so all of this immigration creates a very natural and real demand for housing. The other fact is that the US just has many more hub cities. You can take a look at San Francisco, Boston, New York, Houston, Dallas, and the list could go on. And in Canada, we generally just have two major hub cities, and that is Vancouver on one end of the coast and Toronto on the other. Montreal, Calgary, they're somewhere in the mix. But the US has a lot more land, more small towns where people can move around. Not so much in Canada. We're primarily limited to a very small space and the rest is just frozen. And because of our climate in Canada, we have a natural limitation on how much we can expand north. And if you think about it, Toronto, Vancouver, they're both covered by natural bodies of water. So that also creates another natural barrier to how much Toronto and Vancouver can expand. And because they have sort of better climates than the rest of the country, people naturally gravitate towards Toronto and Vancouver. Having said all that, home prices are falling. Yes, that's a fact. But they are still nowhere near anything that closely resembles affordability. As the price point to buy a home drops because of the rising rates, that means your payment on your monthly mortgage also goes up. So on a net basis, nothing really changes. You end up at a net wash. And that is the crux of the issue. According to a recent survey, close to 20% of Canadians had no choice but to move just so they can find a place that they can call home because of lower cost of living, because where they're moving from is getting out of control. They're getting priced out. Housing affordability remains to be an issue today, especially in the concentrated areas of Ontario and BC. Now, if we focus on Ontario for a very quick second, home prices are falling or they're climbing very slowly, just depending on where you live. But the average price of a home in Ontario is still over $880,000. Now, to me, that is still not affordable. And because of all the rate hikes we've seen, the prime lending rate at most Canadian financial institutions is now at 4.7%. Compare that to 2.75% that we saw back in January. These rising interest rates, they're translating into higher mortgage payments for many homeowners who never expected their monthly mortgage payment to go up as quickly as we've seen in the last little while. Suddenly, these increased costs are taking up a much larger portion of family budgets, stretching finances to the absolute max. Not to mention that the cost of living is just going up in general because of high inflation. We have higher mortgage costs, higher gas costs, higher grocery bills. Every single thing has gone up. So you have the same level of services, same level of products, everything just costs a lot more, but your income hasn't gone up. And this is what's stretching a family budgets. Sure, it's true that rising mortgage rates have helped cool down housing prices, but that doesn't mean we are anywhere close to levels of affordability. In fact, those higher mortgage rates are now adding to the financial stress of home buyers because now they need a higher level of income to qualify for that same level of mortgage just compared to a few months ago. Now, unless of course you're gambling your money on a Brampton mortgage, which is a topic for maybe another video. If you know what a Brampton mortgage is, leave a comment down below for those that don't. Anyways, across Canada, the average income needed to buy a home has now gone up by $18,000 just from March to June. In BC, this is where home buyers have been hit the hardest. They now need an additional $36,000 to buy that very same home just from March to June. Now, I don't know about you, but my income definitely has not gone up by $36,000 in the last 3 months, let alone $18,000. Maybe not even at all. I'm still making the same, but housing costs have gone up that much more because of this balance or imbalance between rising rates and lower prices, higher mortgage payments. My point is that even though housing prices have fallen on the surface level, you need a higher income still to qualify for that home. A lot of people are now thinking or incorrectly assuming that, hey, prices are falling, now I can go out and buy that home. Well, the problem is you're missing that other side of the equation. And when it comes to real estate, you don't want to do bad math. So I hate to break it to you or burst your bubble, but homes are not suddenly more affordable because on the surface level, prices are falling. You have to factor in that higher mortgage payment. And it's this higher stress test rate that's really adding the pressure on the income side of the equation. Generally speaking, for every 1% the interest rate goes up, you qualify for about roughly 10% less of a mortgage. The only way to get some sense of affordability back or get close to housing affordability in Canada is that during a rising rate environment, during a period where you have a higher stress test, you need housing prices to come down even further, much further. If the mortgage rate stabilizes and if housing prices continue to fall, then yes, then you can get a sense of housing affordability getting closer. But we're not there just yet. I really want to drive this point home. Housing prices need to drop significantly more to neutralize the impact of higher mortgage rates. And unless this happens, we will not see any sense of affordability come back to Canada's housing market. Actually, if you watch my last video, you'll notice that Canada has many regional housing markets. So there are some pockets of affordability out there. Now, if you're not interested in watching that video, I'll give you a little bit of a teaser on what I talk about in a lot more detail in that last video. So here's a quick summary. Canada has a wide-ranging spectrum of housing prices, and each area has its own regional housing market that has seen a hot housing market or hasn't seen that much movement. So for example, if we take a look at Toronto, the average price of a home as of June is around $1.2 million. Now, if you look at Halifax, that price is less than $550,000. Calgary, less still, $530,000 is your average price. Edmonton, closer to $400,000 is the average price. In Winnipeg, you're looking at prices in the 300s where you can get a home that's comparable to Toronto for around $360,000. That's what I mean. Canada has a wide-ranging spectrum where you can get a home for $300,000, $1 million, $2 million. It just depends on where you're willing to move and what your local area housing market is. Because the main run-up that we've seen in housing prices has mainly impacted BC, mainly impacted Ontario, and to a lesser extent, Quebec and the Maritimes. Just a quick thank you for all those that have joined the channel's membership base. This content is here thanks to you, so thank you. If you'd like to continue to support the channel, all the info you need is in the description. So far, we've talked about what's happening to potential home buyers and current homeowners. Let's turn our attention towards the investors, the very same investors who are recently making headlines for buying up 20 to 25% of all properties available on the open market. I was recently talking to one of these investors, and this is how our conversation played out. They had just purchased a suburban condo as an investment property in the GTA housing market. The financials on this property no longer made any fiscal sense only 4 months after they had purchased this property. And that's because the rent on their property could no longer even cover the interest portion of their mortgage, especially after a 10x increase in the central bank's lending rate. So the investor had two options: either continue to bleed money every single month or sell the property at a loss. So what option did they take? Well, let me ask you this first. If you are in this very same scenario, what option would you take? Would you continue to lose money on that property every single month or sell at a loss? Well, turning back to the investor in this conversation, They chose to sell their property at a loss instead of continuing to bleed money every single month. But here's the thing, this investor I'm talking about is not the only one in this situation. This is just the start of the wave. There are many, many more investors that are going to be facing this type of decision in the next little while. Every quarter, there's more bad news for those investors. The mortgage rates are going up, property values are falling, and there are more renewals happening. That means more negative cash flow. You really have to ask yourself this question: does it make sense to hold on to the rental property that you know is losing value in terms of its price every single month? And on top of that, you have to absorb that negative cash flow. As long as these rates stay high, more and more investors will have to make this decision and come to reality, and they will be forced to sell. And this forced selling will create more downward pressure on pricing. Over the last year, the central bank issued repeated warnings to investors that they pose a risk to the market as it became a larger buyer of properties. Everyone wanted to be a real estate investor. Everyone wanted to be a real estate agent. Everyone wanted to make easy money in our hot real estate market. Investors are more likely to sell in a downturn because they don't live in the properties that they own. And the volume and the type of debt that they're taking on, specifically mortgages with a floating rate, would make them more likely to experience a financial squeeze, especially if interest rates rise and prices fall. And that's exactly what's playing out in the market today. RBC has called out the country's real estate market, saying that we are headed for a historic downturn, the biggest downturn that the country has ever seen in the last 40 years. Bubbles burst, especially when interest rates go in the other direction. The question is, when is the inflection point? And based on what we're seeing in the market right now, that inflection point was February of 2022. A lot of investors borrowed money even for that down payment on top of the mortgage. That means they owe debt on 100% of that property. All that debt, all that mountain of debt is a lot more expensive today than it was just a few months ago. First, it was a pandemic, and today it's the rising cost of living. Canadians just can't seem to catch a break, and many are at a breaking point. It's tough out there, and this topic doesn't get a lot of coverage or attention, but it impacts us all, and that's our mental health. Working professionals are experiencing an increased strain on their emotional well-being, and I can say that from personal experience. According to a recent report, the mental health of Canadians in June was at the lowest level since the height of the Omicron wave back in January. Many employees are now starting to return to the office, and the concern of COVID is still around. But now you have to add on top the pressure of the rising cost of living. This is impacting workers and their families. Is your employer doing enough to protect your mental health? I want to hear from you, both the good and the bad. Let me know in the comments section down below. What is your employer doing? A lot of HR departments may have developed some sort of superficial wellness initiative, but if I'm being honest, that's just window dressing. Some people might say, oh yeah, stress, it's totally normal. It's just a part of life. Almost making you feel weak if you're really stressed out. But stress should not be normal. We shouldn't just say, oh, if you're stressed out, just learn to live with it. Just learn to deal with it and you'll be fine. We need to have a fundamental look at our workplaces. We're asked to do more, work more, balance and juggle multiple competing priorities, all the while worrying that you're about to let something fall through the cracks. And God forbid if you do, then you get called out for making careless mistakes. We're dealing with more and more anxiety, more and more uncertainty, and part of it is financial stability. So it's no wonder why Canadians are more stressed out and why mental health is deteriorating. I honestly believe the companies that take care of psychological health and the safety of their employees are the ones that will come out on top, whether through its better recruitment, retention, or productivity. And above all, you are not in this alone. If you are stressed out, go seek help. Talk it through. Don't let stress bottle up inside you. Thank you so much for watching. I hope that you had some meaningful takeaways from this video. If you like this type of content and you want to see more of it, hit that like, subscribe, and thanks button because it lets me know to produce more content like this. Make sure to check out all the links in the description below for products and services I use on the daily, and I want you to check them out. You might find something pretty cool. So all the information you need is in the description below. That's it for now. I'll talk to you in the comments section.